It's now my pleasure to introduce our speaker for this morning's session, Tim Hunt. Tim is an executive director with Rabobank's Global Food and Agribusiness Research and Advisory Unit. And Tim's responsibilities at Rabobank include analyzing developments in the regional and global dairy markets, developing the bank's medium-term dairy forecasts, and advising the bank on its engagement with the dairy industry. He's a professional economist with 18 years of experience and the lead author of Rabobank's annual and quarterly global dairy market reports. I'd like to welcome Tim to the podium now.
I might just clear up something in terms of personal introduction as to why I'm here and why I speak this way. I actually was born in America, believe it or not, in Alabama. Now, that's actually not a joke. I have my U.S. passport here. I know even the president occasionally has to prove where he's born, so I carry my U.S. passport. But the astute among you will be starting to pick up that is not an Alabama accent. So I moved at age 3 months. My parents took me to Melbourne, Australia, where apart from 3 months in Europe, I lived most of the first 40 years of my life. 3 years or so ago, I moved with my young family to the United States, having been with Rabo already for 6 years in Australia. And as a dairy analyst, the reason I did that was that I could see that the United States was entering a period of enormous change in terms of its dairy sector that was going to bring a fundamental shift in the way the market behaved and where the opportunities lie. In particular, a reorientation towards export markets and the growth prospects that we saw there. In the first 3 years here, that's certainly proved to be the case. It's had some ups and downs, but at the moment, that international marketplace is providing some real positives for the US dairy sector, particularly at a time here in California where we're looking for some positives. I am part of a much larger team. Rabobank is a global agribusiness bank, here trading under the name Rabo North America. It's one of the largest banks in the world, and wherever we bank, we lend money to farmers, producers, food companies, processors, and traders of dairy. The banks always thought that if it understood those businesses, if we understood your businesses, then we'd be better placed to be a real business partner for you. As a result, it's long invested heavily in a team of analysts who are located everywhere you see those icons on the global map. There are around 70 to 80 analysts, and their job is to work with our clients and those we speak to in these markets and really try and understand what's happening in the Indian dairy market, what's happening in New Zealand. I coordinate a team of 13 dairy analysts globally, based out of New York, and it's my job to bring that together into a global picture and look at what it might look like as we move ahead, trying to position ourselves and speak to you meaningfully about what we can reasonably assume is going on and on what the future might hold. I'm going to ask at this point, I know I need to keep the microphone because I believe we are recording. The title of the presentation is generally going to focus on the market outlook for dairy in 2014. But encapsulating the key theme here, we're talking about exceptionally high prices in the world market at the moment. That will inevitably generate and is starting to generate a wave of milk supply that we'll see hit the market around the middle of this year. But it's our belief that that's only going to partially quench the global market's thirst for this product. For reasons we'll outline, that has a lot to do with China, we believe that despite this increased wave of milk, prices will only gradually ease over the course of this year. We'll have time for questions and answers at the end, and I look forward to that discussion. At the moment, we're going to run through a presentation in 3 sections, looking at what's happening in the global and local markets, why are prices so high, our view on the 12-month outlook, and putting some prices around that, and considering some alternative scenarios, because we know we cannot tell the future with certainty, and we'd like to discuss some of the things that could lead to alternative outlooks. At the moment, we're seeing prices in the international dairy market holding at exceptionally high levels, near record levels. If we look at the prices of cheese, whole milk powder, skim milk powder, butter, trading, FOB, Oceania, prices close to record levels have held there for some time. And even more encouraging, the 6-month forward pricing on the GDT or the Fonterra auction platform is showing those prices stretch out at similar levels for half a year to come. So extremely unusual situation by historic standards. This is inevitably starting to flow through to the producer side of the market. As we always see with some lag, this hits the farm gate and milk prices go up. In this chart, we're looking at the price of milk stripped back to a US dollar per litre equivalent. But if you halve that, you more or less get cents per hundredweight. US prices, we all know, this is an all milk price, have pushed above $20 per hundredweight. The increases we've seen in places like New Zealand and the Netherlands have been even sharper. They've tapped into export markets somewhat better than us. And in China, and this is a really important point, milk prices, which have been high for some time, have jacked up enormously in the back half of last year. And they're now being paid around 69 US cents per litre, or almost $35 US per hundredweight. That's an average milk price. If you want something coming from a quality farm where you can guarantee it's safe, add 10 to 15% on that. And that's a very important point because we're going to speak quite a lot about why that is and its implications. So producers around the world, this is a small sample, but we're seeing the same in Uruguay, Brazil, Argentina to a greater or lesser extent. Producers are seeing very high milk prices. At the same time, margins have been further boosted in intensive feeding areas where they're using corn, soy, rather than pasture. We're seeing feed costs come off significantly, similar to what we've seen in the US market, which is further boosting that margin on farm. Not here in California, but in most places around the world, the weather has actually been more favourable for dairy production also in recent months compared to 12 months ago when conditions were very difficult. The European winter has been extremely mild. We've seen a phenomenally good season in New Zealand for their peak late last year and early this year. Drought in Australia as well, but generally weather conditions have been good. As a result of that, not surprisingly, milk production is starting to increase in export regions. In this chart, we're looking at milk production growth in the big 7 export regions of the world combined compared to 12 months prior. What we saw through most of 2013 was a protracted period of stagnant milk production or milk production falling heavily, even worse than we saw after the global financial crisis in 2009, as producers were hit by bad weather, not so high milk prices, and exceptionally high feed costs. You know the story. We have seen production start to recover in the back half of last year, and by October, milk production in these regions was up almost 4% year on year. So that wave of milk is starting to come. That's also, with somewhat of a lag, starting to hit export markets as well. Similar to the production chart we saw, this is growth in export volumes of dairy from those same export producers, which went into negative territory in 2013 and has started to finally pick up. But we're in the early stages of recovery here from a real shortfall of product available on the world market. Now that ordinarily would be inflationary for world market prices. But the reason it's proved to be hyperinflationary for world prices is that at the same time as world market volumes have been low in terms of trade, China has hit a supply crisis. This chart, we're looking at milk production growth in China, represented by this area. This is a country that back in the mid-2000s was boosting milk production by 15 to 20%. The melamine crisis hit and it fell to about 5%. And in recent years, it's really been low single digits growth rates. I think that it's been unappreciated how difficult it has been to boost supply in China. But this turned really nasty in 2013, where it appears that milk production has fallen at least 6%. We hear reports from some sources of even greater than that. That's a big deal in a market that's now very large and where demand is still trying to grow. I think it's very important to think about why it is that we've seen supply growing slowly and now falling. Some of the reasons are structural. It's surprising to many to learn that the cost of producing milk in China these days is actually very high. They've moved towards a much larger farming systems. We're seeing lots of dairies set up with 2,000 to 4,000 milking cows. And they're buying the sort of feed rations that you're trying to buy for your operations. They face a couple of problems. Firstly, they have a domestic corn price support system to try and encourage more growing for corn so they're not completely reliant on imports. As a result, while we've seen corn prices here fall to around $4 per hundredweight, they're still paying $7, $8 per hundredweight. Also, they don't have a well-developed industry growing quality alfalfa hay. So if any of you have visited farms inland China, they're unloading bales of hay that come from your neighbours. That's an extremely expensive product. Once you get it off onto a Chinese port, it's at least $200 a tonne higher price than what you'd pay. Then you have to get it inland 100 miles or more. On top of that, they have problems with the quality of almost every input that they use. So the costs of production are very high, which at most price levels makes imports look extremely attractive. There are some more medium-term factors which are challenging growth of supply in China. Firstly, small farmers are being pushed out of the industry. The government is not happy with the fact that still around 55% of supply comes from farms that have 100 or less cows. A lot of supply coming from 10 to 15 cow type operations. They do not regard this as a way to establish a safe supply chain going forward, and are removing subsidies from these types of smaller farms and pushing the subsidies to larger farms to try and push them out. At the same time, the economics of these small farms are not looking as good, because if you're milking 10, 15 cows, the actual value of your labour is a really important determinant of whether that makes sense to milk those cows. And as you see wage rates going up 15% or so every year in the cities, the cost of you staying on the farm is going up increasingly, and many of these people are seeing actually the returns better in recent years just to culling the cows and going to the city. You would have read, and we work with a number of large farms in China. We're seeing a lot of investment in larger farms by independent players, private equity, processors and the like. They are having enormous challenges operating these systems. As you know well, these are very management-intensive businesses to run. They have little or no experience in running them, and even if you bring a Californian dairy manager over to operate it, they find pretty quickly there are some differences in how you have to run the system here in China. I visited one place and they said at corn silage time, they have 800 tiny trucks a day that come in and out of their place unloading the corn. That's a different challenge to manage than probably you'd face on your operations. More temporarily, and this is why 2013 got really nasty, we saw bad weather in China and a wave of foot and mouth disease. Foot and mouth disease we regard as endemic in the Chinese system, and it appears every 3 to 4 years they get a particularly bad wave of it, and they've just been through one of it that has led to yields dropping and fairly heavy culling in certain regions of China. As a result of these factors, milk production has fallen, and China has really been short of product. State media is starting to report cases of stock outs or product just not being on the shelves in China. These are photos. I can't read Chinese, but we have Chinese colleagues who do. And these are photos from the north and south of China in the local media showing empty shelves, typically of lower-end UHT products, as the Chinese processors push available milk to the higher value-added products. We're also seeing fairly significant retail price inflation, particularly in these lower-end products, where some products have gone up in price 30 to 40% in the last 12 months. China has tried to solve this problem by rushing to the world market to procure more product. So remember, we're talking about a period where really there's been flat or declining product available in the world market, and the largest importer in the world has decided it really needs to ramp up import purchases. In this chart, we're looking at 7 or so of the world's largest dairy importers and the amount of product they buy from the market every year. You can see that 5 or so years ago, China was an important but not dominant importer. Its purchases have ramped up every year, and last year it increased purchases by around 40% from the international market. When you're that big to start with, it's a big deal. It's like adding another Algeria to the world market, and Algeria are a top 5 buyer. To put it in another context, it's like China coming into the marketplace last year and saying, we'll buy what we used to buy, plus we want all of Ohio's milk and all of Nevada's milk. It makes a fairly big impact. So vigorous buying from China, from a shrinking pool of product available on the world market, inevitably has squeezed a lot of people out. That's just the maths of the equation. This line looks at the total amount of product available in the world market. You can see we've had years of very strong growth and then going negative in 2013. The blue lines are the amount of additional purchases China made from the world market. Light blue is Russia, who's also been buying quite big. The amount of product available for non-Chinese, non-Russian buyers on the world market is in orange. So for years they've been able to top up. 2013, we got a big problem here. They have been left with significant reductions in product to purchase. So a lot of buyers, West Africa, North Africa, and Middle East, parts of Southeast Asia, they've been squeezed out. There's just not enough product to go around, and prices have pushed up to make sure that they're squeezed up out of the market. And that is why we see the exceptional high prices on the world market we see today. In the US, a couple of local dynamics have been also interplaying to change the way your prices interact with world market prices. Firstly, milk supply growth has really been very underwhelming in recent data through to November, but also anecdotally at the moment as we enter or as we're in February. Normally, we would have expected to see a stronger response, but it takes a while, as I appreciate, for the margins that appear on markets to feed through to the farm gate. We have feed quality issues, and then there are some temporary issues slowing down growth. As we'll get to in a minute, we think there are also some more medium-term issues that may keep growth quite slow throughout this year. But not a lot of growth, if any. November was basically flat. At the same time, US consumption, at least of cheese, has improved. Dean Foods reported their results yesterday and reported a 2.2% contraction in fluid milk sales in the closing quarter of last year. Fluid milk remains sick and is not getting a lot better, particularly as we'll have to push through milk price increases, and we'll see the SNAP or food stamp program ratcheted down next year. But cheese sales have improved through the back half of last year. So at a time when milk supply growth was pretty slow, we did see an improvement in consumption of milk in some form in the US in the back half of last year. But the real story has been on the export side of the equation, where buyers offshore have been scrambling to get hold of product, turning to the US, and we've seen exceptionally strong growth in US exports of powders, but also butters, cheeses, and whey. That has helped clear out stocks from the US market. Last year we had quite a bit of stock sitting around in various forms. That's been cleared out. We've shifted it to the international market, and importantly that has meant while the world market has stayed very firm, US prices have been moved up closer to the world market. So the discount we had 3 to 4 months ago to the world market has really closed up as buyers come to this market and take out all the product to fill shortfalls elsewhere. So the US market situation in the last 3 months has been more positive than anywhere else in the world. So a summary of current market status. Milk production is rising again in export regions, as you'd expect. But the lack of stock we had and some improvement in consumption locally in regions like the US means that export growth has been delayed and isn't that strong yet. At the same time, China and to a lesser extent Russia have been on a buying spree. So international prices have had to stay very high to ration the amount of supply that is out there. US prices have moved even more strongly upwards from tight international demand and some firming in the local market. But most rational people would at this point in time be thinking, okay, we've seen this movie before. Surely we'll see a very strong wave of milk supply growth. We'll see demand collapse from these high prices and we'll be collapsing. We've seen this before. So let's run through our view on the likelihood of that. Feed markets, of course, are going to be important. If we look at the grains and oilseed complex, prices should remain low through 2014 because the amount of stock we have in the global market relative to the amount of these products used has started to improve. In the 2012-13 season, because of the high incentive to plant these crops and the relatively good weather, we saw production of grains and oilseeds globally increase almost 30%, which takes us into this season with an improved stocks to use ratio of approaching around 22%, which is the best we've had in about 4 years. It's still nothing like the comfort we saw in the early 2000s, but it's better and should help us keep feed prices down. So if we're looking at high milk prices, lower feed costs, and the expectation of better weather, surely we'll see milk production growth. But there are some drags on the amount of growth we expect. In the US, we see at least 4 medium-term drags, even as the temporary factors like feed quality start to clear up. A lot of our customers all around the US are talking about if we see improved returns, we'd actually like to rebuild our equity for a while rather than necessarily build new dairies or buy new cows. We've had a tough run of it. Secondarily, particularly at the larger scale, we see our producers talking about uncertainty of immigration reform and wanting to see what that looks like before I go out and build a substantial new dairy. In some parts of the US, credit is also less readily available than was the case before 2009. And some banks just don't have the same appetite for dairy that they used to have. And finally, in some regions, and in Idaho on a recent visit, I was really struck by the number of our producer clients that were saying, as my profits improve, I'm going to take that money and invest further in my business, but I'm going to buy feed land to grow more of my own feed, give myself some insulation from feed price volatility, rather than building another shed in the way I normally would have. So these factors, if you look historically at an income over feed cost curve, and you look at the levels we're at now, you'd say, well, in history, at these sort of margins, the US is going to produce 3.5%, maybe more milk this year. We just don't see that happening for largely these four reasons. We think 2% would be a good result for the US, and we're certainly not seeing 2% at the moment. In the EU, most of you will be familiar that quotas on milk supply growth that are imposed at farm level and national level are being phased out as we move to 2015. They've been increased every year by 1%, which has enabled Europe to produce more milk in recent years. But in the last year of this process, the 2014-15 season, there is no increase in quotas. And that will constrain the amount of milk that they will produce in some parts of Europe. And in places like Argentina, where we should be able to get enormous growth out of in terms of their resource availability, we have some real problems. The economy is an absolute mess. You can get US dollars into the country, very difficult to get US dollars out of the country, which makes foreign investors pretty turned off investing in the Argentine dairy industry. There's also been a number of regulatory interventions by the government that has led to people just not investing in the processing industry, which means that the producers are very keen to expand milk supply, but very soon they're going to hit capacity constraints. They'll get lower milk prices as competition for milk dies off, and we'll see that incentive to produce milk slow. So in a number of regions, there are things that will constrain the rate of growth beyond what you might expect. We think that we will see milk production growth in the big 7 export regions of around 3% in the first half of this year. Very strong growth coming out of Europe in particular, and a tail end of a good season in New Zealand and Latin America. As we get to the second half of the year, that growth starts to slow, partly because the comparables get harder. This looks great, but we're comparing it to this. So it's pretty easy to get 3% growth. As the comparables get harder, and as we think milk prices come down somewhat, we'll see less growth. Nonetheless, this is going to push quite a bit more milk out onto the international marketplace. Can we swallow it without crashing prices? China is again going to be central in determining the answer to that. They're too important now not to. We're assuming that Chinese milk production stabilizes in 2014 for the reasons that the foot and mouth disease wave dissipates. We've seen milk prices go even higher, feed costs come down, and that's going to keep some of the smallholders who've been leaving the sector hanging in there longer than they would have otherwise, and it's going to encourage the maximisation of resources at the larger farms. We assume that consumption expands at low single-digit rates. You might be interested to know last year that the numbers suggest that Chinese consumption of dairy only grew at around 1.5%. They just didn't have the product to achieve greater growth. We think that as the supply situation at least stabilises, they might be able to push that up somewhat. On this equation, imports would need to rise by another 15 to 20% in 2014 to balance the market. So somewhat slower, but off a very high base, which means that they don't need to buy all another Ohio's milk next year or this year. It's just got to be all of Iowa's milk. So it's another big lick of product from the international marketplace. And that leaves us with a picture like this. This is Chinese milk production in blue. We've seen that before. This is the product that's coming in from imports. So you can see since the melamine crisis, most of the growth in Chinese consumption has been met by the international market, and in this year we'll see that increase even further with their reliance on imports going to 20% of the market, which is starting to look pretty high, up from about 5% before the melamine crisis. Nonetheless, and this is absolutely pivotal in our expectations of prices, we will have more increase in milk for the world market than China alone will buy. The blue lines are our expectations in each half of how much additional milk we'll be throwing onto the world market. The dotted line is China's increase in imports. And you'll see in the first half of this year, we think that we'll produce considerably more product for export than China itself will soak up on its own. That's important because it means for the first time in 12 months, non-Chinese buyers are going to have the chance to increase their purchases and build their businesses locally. We think that means prices will have to ease as the need to ration supply comes down somewhat. There's more product to go around. Prices will probably ease. But there are at least 6 reasons we're not expecting a price crash. Firstly, the world economy isn't going fast enough to crash. Implicit of the assumption of a crash, when you think about it, you've got to be moving at some speed to have a reasonable crash. The world economy in 2009, when prices slumped, went from around 5% to something around 2%. That's a really big fall. We're only traveling at around 3% at the moment. Europe's stagnant. US isn't growing very, very fast. So we're not relying on a bull run in the economy. Secondarily, we enter this year with less stock than usual. So we need more milk just to refill the pipeline. Thirdly, as we've seen, China's going to probably take a quarter of the additional surplus just on its own in the first half of the year. Fourthly, non-Chinese buyers have been on a diet, forced dieting, for 12 months. So we're starting to see increasing press in places like Algeria and Venezuela of product shortages, people starting to protest around this, and this creates real issues for the governments in these places because they're very keen to come in, purchase more product, get it out there and keep people happy. Let alone businesses in places like Southeast Asia that have enormous room for growth and have just been dying to get more milk to fuel that growth. Fifthly, those economies appear to be improving, so demand is rising all the time. And sixthly, while the wave of milk looks pretty strong, remember it's compared to a fairly weak comparable 12 months ago. In the back half of the year, in our view, it doesn't look so dangerous. In the US specifically, we do expect milk production to rise. So will consumption, but less so than that rise in production, we believe, due to the economy's improving, but the improvement in labour markets isn't that great, and we do have food stamps payments coming down, and prices will have to rise in the coming 3 months in cheese, fluid milk, which will put a dampener on consumption. So there'll be substantial room to boost exports further still. So it's really important this world market does hold up. We think local market pricing will ease pretty much in line with the international market. So what does that actually look like? If we look first at the world market, whole milk powder is a very important reference in that whole complex. We're expecting, these are current prices, the orange line is our forecast. For those that can't see, by the end of the year we're expecting prices to fall 10% or so from where they are at the moment to around $4,300 per tonne for whole milk powder from around $5 in place at the moment. In the US market, we expect Class 4 milk to remain the driver in the federal order, prices to drift down, particularly in the back half of the year, but still be seeing prices of $18.40 for Class 4 milk at the back end of the year. I wanted to put that in context of where the market is today and where it was when we made those forecasts. In this, we're looking at Class 3 milk. The first column is our forecast for each of the quarters of 2014. The light blue line is where the CME forward curve was at the time we made those forecasts in December that we're still sticking with. And the final column is where the CME was yesterday in terms of its forward curve. In terms of the first quarter of this year, we were expecting an uptick in prices, but nowhere near what we've seen. We've seen a phenomenal squeeze in the marketplace. We overestimated how much supply we'd see in the US, but I think moreover there's a temporary squeeze on here. In December, through the balance of the year, we expected significant upside in Class 3 milk, and that has in fact occurred. We think now, though, that we're probably a little bit high on the forward curve. We think there's room for downward movement in the middle of the year on these futures prices as we pass through these costs to US consumers and prices come down somewhat. In terms of Class 4, again, the main difference when we made our forecast in December was we saw significant upside in the second quarter, which has now largely been realised. So our views are pretty much in line now with where the futures curve is today. Based on current futures curves, income over feed costs for most US producers should be positive, in some regions exceptionally positive through the year. In other words, we're expecting a profitable year in general for the US dairy industry. But there are things that can turn out differently to how we expect, and we think it's important to go through those. Some of them are on the upside, by the way. It's entirely possible that the price outlook will be better than we think. In particular, there are those that feel that Chinese milk production will continue to fall in 2014. If that's the case, China will buy even more product than we're expecting. Also, we haven't factored in big adverse weather events in key production regions. We don't have a lot of backup stock. So if we see more events like we're seeing in California at the moment, prices could be even higher than we expect or not come down to the extent we thought. Things in particular that play on our mind in terms of will we go down even further than we think? One of them is in the US. As we've seen, we're assuming only 2% growth in supply. Previous cycles like this, we got about 3.5%. Were we to see that kind of growth, we'd see more product on the world market pushing prices down, and probably difficulties in the US industry getting that to the world market, opening up a discount in the US wholesale market versus the international prices. And finally, we are assuming that once we produce more product than China itself needs in the first half, we'll go to all these other markets and they'll be very keen to buy the product at reasonably high prices. If for some reason their economies are weaker than we thought, or they just don't have the demand, prices may have to fall further to balance this market.